Do you own any Chinese stocks? Alibaba, Tencent, or Baidu? Do you know that you do not actually own the real shares of the companies that you invested? Do you understand that there's a risk that you could lose everything? By everything, I mean you could lose 100% of the money you invested in these Chinese stocks, and you won't be able to get any compensation. This is Grant. In today's video, I am going to explain the risks of owning Chinese stocks via the VIE structure in the US and if we should invest in them. A lot of investors don't understand what they are actually buying when they invest in Chinese stocks. They think when they buy Tencent stock, they own a percentage of the company like the way it is in the US. Well, you don't own anything and you can't own anything. Under Chinese law, foreign ownership in most of the Chinese industries is not allowed. 20 years ago, growth in China was very quick, and they wanted investors from the US because of the huge amount of capital available, and at the same time, US investors and Wall Street also liked the huge growth rates in China and wanted to invest in them. They both wanted access to each other, but a Chinese law prevented them both from doing so. So VIE was born, Variable Interest Entity. It's a structure developed to go around the Chinese law. The VIE structure gives Chinese companies access to capital in the US and Europe, and simultaneously granting American and European investors the access to Chinese stocks. But the VIE says to the Chinese regulator that the company is completely owned by Chinese nationals. But at the same time, it is also saying to the Americans and the European shareholders that they legally own that Chinese company. Let me explain the basic structure of a VIE by using Alibaba as my example. Let's say that Alibaba is on the restricted list, which means that any foreign ownership of Alibaba is prohibited by the Chinese government. So, as a result, Alibaba cannot sell its shares to any investors who is not a Chinese national. But by using the VIE structure, Alibaba creates a Cayman Islands listed shell company with no real business, no real employees or offices, and they also call it Alibaba. To make it simpler, I am going to call the Alibaba in China real Alibaba and the Cayman Islands Alibaba shell Alibaba. So once the shell Alibaba has been set up, real Alibaba then creates a very complicated legal agreements that give shell Alibaba a right to claim profits and control over the assets the real Alibaba has. Shell Alibaba only has a claim on the profits, and it does not give investors any actual ownership. Shell Alibaba then lists itself as a company on the Nasdaq, New York Stock Exchange, or any exchanges outside China, and start selling shares to non-Chinese investors under the same name Alibaba. When Wall Street lists this shell Alibaba, they would get millions of dollars in profit, and investment firms and investors can now put billions of dollars into buying shares of shell Alibaba. Again, this whole time, all of these non-Chinese investors are buying stock in a company called Alibaba. That is only a shell company, not a real Alibaba. The shell Alibaba only has control over the assets and a right to the profits of the real Alibaba in China. So now you might wonder, why would people buy a shell company's stock, not the real company itself? First of all, you can't buy the real stock. It's not allowed. And this structure has been very lucrative. Companies and investors have made billions of dollars, and this process has been repeated over and over for hundreds of Chinese companies listed on New York Stock Exchange and Nasdaq. Currently, there are 250 Chinese companies that are listed on a US stock exchange either directly or as an ADR, with a total market capitalization of more than $2 trillion. It made a lot of people rich. What are the risks with this structure? This VIE structure is fundamentally illegal under Chinese law. Chinese law specifically says that any foreign investment is illegal. But this VIE is finding a loophole and allowing foreign investment, so the contract itself is illegal and unenforceable. It is a common law concept that a contract is constructed to find a loophole of a law is not enforceable. So VIE is illegal under Chinese law. If it's illegal, why are firms doing it? Money. And for the most part, the Chinese government turns a blind eye to it, and it has been like this for more than a decade. And it made a lot of companies and people very rich. Occasionally, without a warning, China, in fact, has enforced its laws, and the investors and the shareholders have tried to enforce the contracts in China but failed. The China Chain case and the Giga Media case both ended badly when they tried to enforce the contracts. Alipay is China's largest payments processing company. It was one of the most valuable companies of Alibaba. In 2011, because Alibaba's VIE structure, 100% of Alipay's ownership was transferred into a different company by Jack Ma. One of the major shareholders at the time was Yahoo. They had a 43% stake at the time. When they found out this happened, they launched legal actions against Alibaba. But because of the VIE structure, Yahoo and the other shareholders, one of them was SoftBank from Japan, they couldn't do anything. They had no legal recourse. Yahoo owned 43% of the shell Alibaba, so it did not technically own any part of the real Alipay at all. What Yahoo legally owned was the 43% of a shell company listed in the Cayman Islands that had some contracts with Alibaba. And of course, under the Chinese law, these contracts were illegal and therefore unenforceable. Eventually, Jack Ma of Alibaba, Yahoo, and SoftBank settled. And according to the view of analysts, Yahoo only got a short end of stick in this deal. And of course, Yahoo shareholders were very angry, but nothing could be done. So with all of these high-profile cases, thousands of investors still continue to invest in the shell Alibaba to this day. And this could absolutely happen over and over, and nothing could prevent the same from happening again. And this could happen to all of the Chinese stocks with this VIE structure. At the most extreme, China could declare that all these VIEs illegal, which would wipe out trillions of dollars from foreign investors and the shareholders. You don't have any ownership of the real Chinese company's assets, so they can be taken away without any warnings or compensation. You could lose everything you invested in these Chinese stocks, yet we still have a total market capitalization of $2.2 trillion. It's so risky. Why are there still trillions of dollars invested in these VIEs? I think there are three major reasons why people are still interested in the VIE structure despite the risks. One, investors simply know very little or even nothing about what they invested in, and most of them think they own the real companies like in the US. Two, the regulators don't regulate enough. There is a risk common disclosed in the VIE annual reports, but that's not enough. What I think is regulators should actually prevent the dangerous listings and provide authentic legal protections to the shareholders if things go south. Three, this structure has been very lucrative and everyone wants a bite. They ignore the risks, or they think because everyone is doing it, it must be okay. I think most of the companies invested in these VIE structured stocks do not talk about it or simply don't really care about it. And there are so many investors, they think China would not cause a turmoil this big to enforce its laws because it could wipe out trillions of dollars in a blink of an eye. All things considered, VIEs are risky, but the reward is very high. You just need to know your risks and what you are actually buying, and understand that they could all be gone in an instant. And what I am seeing at the moment is the disturbance is not getting better, and on the contrary, it's getting worse. In conclusion, I have 3 strategies that I think they could limit your risks, losses, and still give you access to Chinese stocks. The first one is to limit the number of Chinese stocks and the number of shares in your portfolio, and watch the news and the Chinese regulators very closely. If you feel uncomfortable and you think a storm might be coming, get out. The second one is to buy Chinese tech ETFs, because ETFs give you a lot of Chinese companies, but without too much concentration in one particular company. It is very unlikely that the whole Chinese market would be destroyed all at once. The last one is my favorite, which is to buy the Chinese companies you really like on Hong Kong exchanges and clearing. By doing so, you remove the risk of delisting, and if Chinese company is delisted from the American exchanges, the ADRs can be converted. So I think these are the 3 strategies that you can use to lower your risk. And let me know in the comment section what do you think about this VIE structure. And if you like this video, please hit the like button and subscribe. This is Grant. Trade and invest responsibly.